Most people believe that the ultra-wealthy pay a fortune in taxes every year. They assume that billionaires like Elon Musk and Jeff Bezos are writing massive checks to the IRS. But here's the truth that the tax code hides in plain sight. In 2024, Elon Musk paid an effective tax rate of just 3.3%. Jeff Bezos paid just 1%. And how did they do it? Not with complicated offshore accounts or illegal schemes. They used a perfectly legal three-step strategy that has been quietly passed down through wealthy families for generations. It's called buy, borrow, die. And if you stay until the end of this video, you'll learn exactly how this strategy works, why it's completely legal, and how even as a middle-class investor, you can borrow some of its principles to supercharge your own wealth building. If you stay until the end of this video, you'll learn the 3 steps of the buy, borrow, die strategy, how the step-up in basis loophole allows the wealthy to permanently eliminate capital gains taxes, and the massive proposed reforms that could close this loophole forever. I'll also show you how to apply the principles of this strategy on a smaller scale without needing a billion-dollar portfolio. By the time we're done, you'll understand why the rich get richer and how you can use their own playbook to build your own wealth. My name is your name, and today we're pulling back the curtain on the biggest tax avoidance secret of the ultra-wealthy. Let me start with a story that will reframe everything you think about taxes. In the 1990s, a law professor at USC named Ed McCaffrey noticed something strange. The wealthiest Americans seem to pay a much lower effective tax rate than the middle class. They weren't cheating. They were just using the tax code in a way that most people didn't understand. McCaffrey coined a term for this strategy. He called it buy, borrow, die, 8L6L7. Today, nearly 30 years later, this strategy has become the cornerstone of tax planning for the ultra-wealthy. And unless Congress closes the loophole, it will continue to allow billionaires to pass on fortunes tax-free for generations 8L7, L9. The buy, borrow, die strategy is not a secret handshake among billionaires. It's a simple 3-step framework that leverages the quirks of our tax code 8L16. Let me break down each step. Step 1. Buy, acquire appreciating assets. The first step is to buy assets that go up in value over time, 8L32. These could be stocks, real estate, fine art, or a business. The key is that these assets appreciate. They increase in value while you hold them. The wealthy don't just buy 1 or 2 things. They build diversified portfolios of appreciating assets that grow year after year. As of early 2026, a bull market has been running for much of the past 15 years, and many long-term investors have seen significant gains, 7L9L10. But here's the catch. If you sell an asset that has gone up in value, you trigger capital gains tax. For someone in the top bracket, that's a 20% federal tax, plus the 3.8% net investment income tax, plus state taxes. In a high-tax state like California, the combined rate can exceed 30%, 711L12. So the wealthy don't sell, they hold. Step 2, borrow, use assets as collateral for tax-free loans. Asterisk, once you have a portfolio of appreciating assets, you don't need to sell them to get cash. Instead, you borrow against them, 8L45L46. The most common tool for this is a securities-backed line of credit, or SBLOC. Think of it as a home equity line of credit, but instead of using your house as collateral, you use your stock portfolio, 7L21. Here's the magic. Borrowed money is not considered taxable income. According to the IRS, a loan is not income. It's a liability you have to repay. So when a billionaire borrows $100 million against their stock portfolio, they pay zerolos in taxes on that money, 9L35, L37. They can use that cash to buy a vacation home, start a business, or fund their lifestyle. all without triggering a single dollar of capital gains tax 7L49L50. The interest rates on these loans are often quite low. In many cases, wealthy investors can borrow at rates that are significantly lower than the long-term appreciation of their assets. If your portfolio is growing at 10% annually and you borrow at 5%, you're making a 5% spread, free money 11L43L45. This is the financial engineering that allows the rich to get richer without ever paying the taxman. Step 3. Pass assets to hires with a stepped-up basis. This is the most powerful and the most controversial step. When an investor dies, their assets do not pass to their heirs with the original purchase price as the cost basis. Instead, the tax code steps in and resets the basis to the current market value 1LL18L22. This is called a step-up in basis 9L15L17. Let me give you a concrete example. Imagine you buy stock for $1 million. Over 30 years, it grows to $10 million. If you sell it during your lifetime, you owe capital gains tax on $9 million of profit. But if you hold it until I die and leave it to your heirs, the tax code wipes out that $9 million gain. Your heirs inherit the stock with a new cost basis of $10 million. They can sell it the next day and owe zero in capital gains tax 611L137 L43 L44. This step up in basis effectively eliminates capital gains taxes on appreciation that occurred during your lifetime 1311 L13. It's not a loophole that was accidentally created. It's been a feature of the tax code for nearly a century. Dating back to the early 20th century, when tracking asset appreciation over long periods was difficult and record-keeping was messy, 13L15. But today, with modern technology and valuation methods, many economists and policy players argue that it's a relic that disproportionately benefits the wealthy 13L15L18. The step-up in basis is not a small tax break. It is one of the largest annual tax expenditures in the federal budget. According to projections, it will amount to more than $500 billion over tax years 2024 to 2033, 13LL21. That's $500 billion in potential tax revenue that goes uncollected because of a rule written decades ago. Why this strategy is completely legal and why it's so controversial. Asterisk. Here's what the anti-tax crowd and the tax reformers agree on. Buy, borrow, die is perfectly legal under current law. There is nothing fraudulent or hidden about it. 4L31, L34. The wealthy are simply following the rules as written. The question is whether those rules are fair. Critics argue that the step-up in basis is the mother of all tax loopholes. 11L33, L35. They point out that the wealthy can consume from their wealth without ever paying tax on the gains, while middle-class workers pay tax on every dollar they earn. Senator Ron Wyden has called it the primary mechanism billionaires use to dodge taxes. 4L37, L39. A recent article in The Atlantic labeled the strategy, "How to Be a Billionaire and Pay No Taxes." 11L32, L35. But there is another side to the debate. The National Taxpayers Union Foundation argues that the step-up basis is necessary to prevent double taxation. Assets are already subject to estate tax, which can be as high as 40% for estates over the exemption amount. Without the step-up basis, heirs would pay both estate tax and capital gains tax on the same assets, a double hit. 11L23, L27. This is the core tension in the debate, how to balance tax fairness with the need to avoid overtaxing inherited wealth. Real examples: the billionaires who use this strategy. Asterisk. You don't have to take my word for it. The headlines are full of examples. In 2022, Elon Musk borrowed billions of dollars against his Tesla shares to help finance his purchase of Twitter. 13AL31L33. Jeff Bezos has taken out loans backed by Amazon stock to fund his lifestyle and his space exploration company, Blue Origin 13L33L35. Neither of them paid capital gains tax on those borrowings. They simply used their assets as collateral to access cash without selling. In fact, a 2025 analysis by Bloomberg Tax found that most of the wealthiest taxpayers don't even need to borrow. Their annual taxable income from salaries, dividends, and business profits is more than enough to cover their living expenses. 13A-L40-L42. They simply hold on to their appreciated assets, watch them grow, and then pass them on to their heirs untouched. The result is that about 40% of their economic income, total gains and earnings, goes entirely untaxed during their lifetimes. 13L47, L49, the risks. How buy, borrow, die can backfire. Now, I've made this strategy sound like a free lunch, but there are significant risks that the wealthy must manage. First, margin calls. When you borrow against your assets, the lender requires you to maintain a certain loan-to-value ratio. Typically, you can borrow up to 50% of your portfolio's value. 10L44, L45. But if the market crashes, your portfolio value drops and your loan-to-value ratio rises. The lender can issue a margin call, demanding that you either deposit more cash or sell assets to pay down the loan. 10L45, L46. Financial planners often recommend borrowing no more than 25% of your portfolio for long-term use to create a buffer against market volatility. 10A, L46, L47. If you have a $1 million portfolio and borrow $250,000, even a 50% market crash would leave you with $500,000 in assets and a $250,000 loan, a 50% loan-to-value ratio. You would likely survive the crash without a margin call. 2L18L22. Second, interest rates are not fixed. Most SBLOCs have variable interest rates tied to benchmark rates like SOFR. If interest rates rise, your borrowing costs increase. In 2026, with the Federal Reserve holding rates steady near 3.75% and some forecasters predicting rate hikes in 2027, variable rate debt is a real risk. Third, the loan must eventually be repaid. In the classic buy, borrow, die strategy, the loan is repaid by the estate after the borrower dies. The estate may use other assets or life insurance proceeds to pay off the debt. But if the loan exceeds the estate's liquid assets, heirs could be forced to sell assets at inopportune times. Asterisk the 2026 reform landscape. Is the loophole closing? This is where the story gets even more interesting. In 2026, there is a growing political movement to close the buy, borrow, die loophole. The Robin Hood Act, reintroduced in the 119th Congress, would impose a 20% excise tax on loans and lines of credit backed by capital assets. 4L6L10. Proponents estimate this could generate up to $147 billion in revenue over a decade. 12L10L11. Other proposals include treating borrowing as a taxable event, a deemed realization tax, requiring prepayment of capital gains tax at the time of borrowing, a withholding tax, or applying a flat excise tax on certain loans. 4L44, L48. The Yale Budget Lab analyzed excise tax options and found they could bring in between $102 billion and $147 billion, depending on the tax base used. 12L36, L40. The political landscape is complex. While Democrats have introduced bills like the Billionaires' Income Tax Act, which would impose a minimum tax on the unrealized gains of the ultra-wealthy, passage is not guaranteed. 11L36, L41. The step-up in basis has been a feature of the tax code for nearly a century, and powerful interests support its retention. But the tide may be turning. As deficits grow and public awareness of tax inequality increases, the buy, borrow, die loophole is squarely in the crosshairs. Asterisk what this means for you, how to use these principles in your own life. You might be thinking, I don't have $1 billion, I don't have a team of tax lawyers. How does this apply to me? That's a fair question. While you may not be able to implement the full buy, borrow, die strategy, you can borrow its principles to build your own wealth. Principle 1. Buy appreciating assets and hold them for the long term. You don't need to pick individual stocks. A low-cost index fund like VTI or VT is a perfectly good appreciating asset. The key is to avoid the temptation to sell every time the market dips. Let your assets compound over decades. Principle 2. Use debt strategically, not recklessly. The wealthy use low-interest debt to preserve their appreciated assets. You can use a mortgage to buy a rental property, or you can use a low-interest loan to invest in your education or your business. The key is to borrow only when the expected return on the investment exceeds the cost of the debt. In 2026, with mortgage rates around 7% and credit card rates over 20%, most consumer debt is toxic. But a low-interest student loan used to increase your earning potential? That's strategic debt. Principle 3. Understand the step-up in basis. If you have appreciated assets that you plan to leave to your heirs, you should understand how the step-up works. In many cases, it makes sense to hold on to appreciated assets rather than selling them and paying capital gains tax, especially if you are charitably inclined or have a large estate. This is a complex area, and you should consult with a tax professional. But knowing the basics can help you make better decisions. Principle 4. Consider using a securities-backed line of credit if you have a substantial portfolio. Many brokerages offer SBLOCs to clients with $100,000 or more in assets. The interest rates are often lower than personal loans or credit cards, and the funds can be used for almost any purpose. The key is to borrow a small percentage of your portfolio and to have a clear plan for repayment. You should never use an SBLOC to speculate on risky assets, and you should always keep a cash buffer to cover a margin call. A story of smart borrowing. Let me tell you about a client named James. James owned a successful small business and had built a stock portfolio worth about $500,000. He wanted to buy a rental property for $200,000. Instead of selling his stocks and paying capital gains tax, he used a securities-backed line of credit to borrow $200,000 at 6% interest. He bought the rental property, which now generates $18,000 a year in net rental income. That's a 9% return on his borrowed money versus the 6% he pays in interest. He makes a 3% spread, and his original stocks continue to grow. James is not a billionaire, but he's using the same principle. Borrow against your assets to invest in other assets. The bottom line, knowledge is power. The buy, borrow, die strategy is not a secret code. It's a reflection of how the tax code works. And while you may not be able to fully replicate it, understanding it gives you a deeper insight into how wealth is built and preserved. The ultra-wealthy are not smarter than you. They have simply mastered the rules of the game. Now you know those rules too. Will Congress close the loophole? Maybe. But for now, buy, borrow, die remains a legal, powerful strategy for those with substantial assets. And even without the billions, you can borrow its principles to build your own wealth. Your action plan: do this today. Here's what you need to do in the next 24 hours. First, if you have a brokerage account with $100,000 or more, ask your broker about their securities-backed line of credit program. Get the interest rate terms and loan-to-value limits. Second, review your portfolio for any highly appreciated assets you've been holding. Consider whether selling them now makes sense, or whether using a loan or holding until death might be more tax efficient. Third, if you have a financial advisor, Ask them about the step up in basis and how it affects your estate plan. If you don't have an advisor, spend 30 minutes researching the estate tax exemption and the step-up rules. Fourth, commit to learning one new tax strategy each month. The more you understand the code, the more you can legally reduce your tax bill. Fifth, comment below. I'm studying the buy, borrow, die strategy. I'll reply to the first 100 comments. If this video opened your eyes to how the wealthy really pay taxes, hit the like button. It helps others discover the rules of the game. Subscribe and turn on notifications. In the next video, I'm going to reveal why your emergency fund should be in a different bank. The psychology of out of sight, out of mind. The buy, borrow, die strategy is not about cheating. It's about understanding the system. The wealthy do. Now you do too. I'll see you in the next video.